Okay, let's dive right into this explainer. We're going to uncover a pretty mind-blowing fact today. Accountants can actually change the past. Welcome to the Time Traveler's Guide to Accounting, where we're going to be decoding the rules of IAS 8. Here's how we're breaking down IAS 8 today. First, time travel in accounting. Second, the rule book, which covers accounting policies. Third, best guesses, or accounting estimates. Fourth, fixing mistakes through prior errors. And finally, number 5, what happens when time travel actually fails. All right, Section 1, Time Travel in Accounting, Unlocking Comparability and Reliability.
So the absolute core of this standard is this crazy concept of time travel, formerly known as retrospective application. This is where we literally go back and rewrite history to match new rules. We take a new accounting policy and apply it to prior transactions as if that policy had always been the one we used. Why? Because it ensures that when you look at last year's numbers, right next to this year's numbers, it's a true apples-to-apples comparison.
But on the flip side, we've got prospective application. This brilliantly illustrates the exact opposite approach. Here, we leave the past completely alone. Whatever was recorded in prior periods, it stays exactly as it was. We only apply the changes to the current period and future periods moving forward. No time machine required for this one.
Moving right along to Section 2, the Rule Book. These are your accounting policies, essentially the foundation of financial statements.
Now, accounting policies are the firm rules of the game. We're talking about the specific principles, conventions, and practices an entity uses to actually put their financial statements together. And because consistency is so incredibly important for investors and analysts, you can't just change these rules on a whim. In fact, you can only change a policy if an IFRS standard explicitly requires it, or if you can prove the change provides much more reliable and relevant information.
Now, what's really interesting here is how changing a policy voluntarily literally forces you to time travel backwards to adjust those earliest prior periods. Look at the flow. At the date of change, sure, you apply your new accounting policy, but you have to go back to the earliest prior period presented and physically adjust the opening balance of equity, as well as restate your comparative amounts. Only after you do that can you move into future periods maintaining that consistent new application.
Okay, let's dive into our third section. Best guesses, or accounting estimates, and how we manage measurement uncertainty. By relying on these specific examples straight from paragraph 32 of the standard, we can clearly see that estimates are, well, simply our best approximations using the latest reliable information. Things like a loss allowance for credit losses, figuring out the fair value of an asset, or setting up a provision for warranty obligations, all of these involve inherent measurement uncertainty. We have to use estimation and valuation techniques simply because we don't have a crystal ball. And because these estimates are just refined guesses based on new developments, we definitely do not use our time machine here. We only apply these changes prospectively. For example, if you get new information, say you realize a massive piece of machinery is going to wear out way faster than you originally thought, you don't go back and change last year's depreciation. You leave the prior period completely unchanged, recognize the updated effect right now in the current period, and then apply it moving forward. Now, you might be wondering what happens when the line between a hard rule and a subjective guess gets completely blurry in practice. I mean, sometimes a change involves both a new measurement basis and a new estimation technique. So what do? Well, the standard actually provides this fantastic fallback rule. It defaults to treating any ambiguities as a change in estimate. This effectively saves accountants from a bunch of unnecessary retrospective time travel. Because remember, changes in estimates are handled prospectively. So if you are truly stuck and cannot distinguish between the two, you treat it as an estimate, breathe a sigh of relief, and look only to the future. Next up, Section 4. Let's tackle the tricky business of fixing mistakes, also known as prior errors, to correct the record. So the absolutely crucial point to understand here is that errors happen when an entity fails to use reliable information that they reasonably should have known at the time. This is very different from an estimate changing because of totally new information. Prior period errors happen when reliable facts were sitting right there when the statements were authorized for issue, but they were misused or ignored. We're talking about simple mathematical mistakes, blatant oversights, misinterpretations of facts, or, worst-case scenario, intentional fraud. And this perfectly illustrates that if you want to fix a material mistake, you have absolutely no choice but to fire up that time machine for a retrospective restatement to wipe the error from history. Once a material error is discovered, you must go back to the prior periods presented and restate the comparative amounts as if the error had never occurred in the first place.
You have to correct the historical record before you issue your current financial statements.
Finally, Section 5, when time travel fails. Because yes, there are limits to retrospection. So what happens when we physically cannot recreate the past without using hindsight? The standard actually gives us a built-in out called impracticality. But hold on, it demands that an entity make literally every reasonable effort before throwing in the towel. You can't just throw your hands up and say it's too hard or it takes too much time. You have to exhaust every reasonable effort to figure out the past numbers before you can officially declare retrospective application impracticable. Let's dive into the specific conditions that make it clear you can never, ever use modern hindsight to rewrite a prior period's numbers. It's impracticable if you simply cannot determine the effects, or if applying the change requires you to just guess what management's intent would have been years ago. Lastly, and honestly most importantly, it's impracticable if it requires significant estimates and you cannot objectively separate the information that existed back then from the information you know today. Hindsight is strictly forbidden. If your time machine is completely broken and you just can't go all the way back, the rule here is actually pretty simple. Just go back as far as you practically can and start fresh from there. You restate the opening balances of assets, liabilities, and equity for the earliest period possible, even if that ends up being the current period, and you just apply the changes prospectively from that point. This summary matrix is your ultimate cheat sheet for IAS 8. It perfectly maps out our three main destinations and their corresponding time travel rules. Just remember this. Changes in accounting policies require retrospective application. We change the past. Changes in estimates require prospective application. We only look to the future. And prior period errors require retrospective restatement. We erase the mistake from history entirely. So I want you to think about this as we wrap up this explainer. Does your financial history reflect a perfectly accurate past, or is it simply the best available estimates preparing us for the future? That delicate balance between reporting strict history and making practical judgments is what ultimately preserves our trust in financial reporting. IAS 8 exists to make sure that when a company's financial picture shifts, investors know exactly whether it was due to a new rule, a better guess, or a corrected mistake. Thanks for diving into the fascinating mechanics of accounting time travel with me today. Keep questioning the numbers and keep learning.